It says, analytical procedures generally provide the primary form of review evidence obtained by the accountant. The accountant uses an understanding of the industry, client knowledge, and general knowledge about business, accounting, and the economy to develop expectations as to information that might appear. Expectations may be in the form of an amount, such as ranges of amounts. It could be in the form of ratios or relationships, like receivables to sales, right? Normally, let's say my receivables to sales is a certain percent. Then I will look at that to see if it's year to year to year, it's consistent, it looks reasonable. The accountant will compare the client's data to expectations to determine if variances are reasonable. Any difference should be investigated further. Some analytical procedures that the accountant is required to perform include comparing current period, so current year and prior year. CY, current year, PY, prior year. Considering plausible relationships between financial and non-financial. I mentioned that number of employees and payroll data. Comparing amounts reported by the financial statements or ratio amounts and derive those amounts that you expected. Making comparisons using disaggregated revenue data. That would be like revenue month to month or by product line. When fluctuations or differences or expected amounts exceed what the accountant considers acceptable, the accountant will investigate the differences by then making what? Inquiries. So this is what leads us into the inquiries. So a lot of times you'll do your analytical procedures, and we call inquiries now, and then we'll go back and go, hey, I need some clarification here. These things don't look right. What are the inquiries? Certain inquiries. The preparation and fair presentation of the statements, any unusual or complex transactions, significant transactions, especially those occurring near the end of the year. What about that? At the end of the year, maybe they pay off a loan, so their debt goes down, but then their cash goes bye-bye, and then they borrow the money back 3 days later after year end, just so their debt is lower, so the ratios get affected. You've got to look at that stuff. You've got to ask them questions. So you're making inquiries of management about all of these things. Uncorrected errors in the prior year statements. Results of analytical procedures requiring further clarification. Subsequent event, that's an event that occurs after the balance sheet date but before you issue the report. Any suspicion of fraud. Non-compliance with laws and regulations, significant journal entries or AJEs, adjusting journal entries, reclassifying journal entries, things like that. Applicable communications from regulators, related party transactions, litigations, claims and assessments, things that we ask about in an attorney's letter called the letter of audit inquiry, which we don't get. The releasableness of management's estimates, actions taken at board meetings, other matters. All of these are things that we are doing with inquiries. And again, a lot of the inquiries come from your analytical procedures. Reading the statements, make sure you read them. We had to do that in a compilation. We do that in a review. We did not do that in a preparation of financial statements. You didn't have to. Work of other accountants. What does that mean? Basically, there may be a subsidiary that someone else was looking at, so we're going to look at that work as well. Relationship of the financial statements to the underlying accounting records. The accountant is required to obtain evidence that the statements were derived from the accounting records. This may be accomplished by reconciling statements to the accounting records, a consolidated schedule, or other data. Review evidence. So now we're going to obtain the evidence, review it. The accountant may become aware that information provided by the client is incorrect, incomplete, or otherwise unsatisfactory. We should then request that they consider the implications and consider if management's response indicates that the statements may be materially misstated. Upon concluding that the statements may be materially misstated, the accountant will perform whatever procedures we need in order to decide if we want to stay, maybe do additional analytical procedures and inquiries, or we could always withdraw.